Hey, welcome to the 40 Finance channel, everybody. Today we're going to go fishing. We're going to do some bottom fishing for tech stocks using the Seeking Alpha stock screener and using their quant scores on momentum and valuation. Kind of pick some names and then dig a little deeper and see, are these stocks on sale? Is this a rock bottom value maybe to think about or at least add to your watch list? All right, let's jump in here and I'll show you how I set up this stock screener. In case you're playing at home, you just hover over this top stocks and you go down to stock screener. I don't want to push those buttons because I've already set up my filter. And I'm sorting out market cap above 9 billion. Large cap stocks typically start at 10 billion. So I just put in a 9 to make sure I cover them all. And then on sector and industry, communication services, information technology, and I added consumer discretionary as well because you'll see some fringe technology plays in consumer discretionary sometimes. So I'm including that. And then I live in the United States. So I'm just going to focus on stocks that are here in the United States. Now, as far as this rating section, this is essentially disabled because it covers the whole scope from strong sell to strong buy. That applies to Seeking Alpha Quant Formula, authors rating, Wall Street analyst rating. It's just a built-in part of the Seeking Alpha stock screener. Now, before I show you the stocks, I do want to call out that it's a fantastic time to experiment with Seeking Alpha Premium. Having an awesome sale right now, $99 for a full 12 months access to some of the tools that you'll see a lot of times on my channel, particularly today with the stock screener. So if you're interested in checking out that special offer, my affiliate link is in the description, gets you that $99 price point for 12 full months. That's not per month. And you also get a 7-day free trial. They will not charge your card until after the 7-day period. So potentially support my channel, use the link below. I appreciate it very much. Okay, let's jump in here on these stocks and how I'm gonna do this. Let's see, that's the company name. Let me scoot this over because I wanna capture this EPS revisions column here on the screen. But I'm gonna start with the momentum. And you can see how I've sorted this, F being the worst, A being the best. I want to find the stocks that have been absolutely destroyed from a momentum standpoint here in the past short term. And then I want to compare that just using these grades really quickly. I just want to cross compare that with growth opportunity, EPS revisions, and of course valuation. So I would say in a perfect world right now, you might say that the momentum, if we're bottom fishing, we'd want an F in momentum. We'd want A or B in valuation, right? Because that would signify a positive valuation. We'd like to see green in growth. And then EPS revision, we'll just have to do on a case-by-case scenario. If those revisions are going up, well, then that's a good sign too, particularly if you have a strong valuation. Now, MongoDB, which is the first one here, I'm not even going to mess with because even though they have A+ growth and an F on momentum, they have a D in valuation and they have a C- in their EPS revision. So that's essentially a double negative in terms of what we're looking for, which is fledgling stocks that offer growth and a good valuation. The next one is Meta. And what's interesting with Meta, you've got a good profitability score. You've got average on EPS revisions, but you have a B- on valuation. The problem is the growth. A D- obviously cautionary tale there on the growth, but let's take a look at Meta because I think we all know that it has definitely suffered here recently, and let's just see where these earnings estimates are going. All right, so let's just go down here. This is fiscal period ending here in just a couple months. December 2022, bad year for EPS, very bad year, minus 33% on EPS, which of course really screws with the valuation. And at least right now, the projection is that Meta's EPS is going to tank even more next year. So that's sort of a negative sign. On the bright side, you simply don't see an 11 PE on something like Meta. So let's check our growth rates in terms of revenue, because this is another key, right? We might be able to handle some of this EPS if we're blowing out the revenue. And unfortunately, right now, you do have some growth penciled in for next year at 6%. Gets the price to sales under 2. I don't mind this deal on Meta, and I'll take it as I'm buying the QQQ. But as a standalone stock right now, I think I would say that I would personally wait until I started to see some more good news. Because right now, if you bought it today and you held it into the forward EPS after January, you're still going to see potentially another minus 10%, and that's going to mess with your valuation. So Meta, I don't think is a bad deal. I think we know a lot about this stock and what they're trying to do for the future. My 2 cents is, though, it doesn't really match what I'm looking for in terms of double-digit growth rate, at least some positive traction for EPS next year. It just doesn't showing those things right now. All right, flipping back here, and we got our momentum sorted. Let's just skip to this growth column and see who is actually growing. All right, so we have AMD. Let's take a look at this one. And again, we'll go to this earnings estimates table, fiscal period ending in 2022. $3.51 is what they're projected for this year. That is a 25% growth year over year. We're getting to the time of the year, though, when everyone's going to be staring at 2023. And I guess on the positive side, you still do have some EPS growth. So unlike Meta, you have a small EPS bump anticipated for next year, plus 5%. How about that revenue? This year's revenue, absolutely outstanding at plus 43%. Next year, though, it is short of double digits, but 8.3% if they were to hit that, considering how down people are on chips right now. I'd be inclined to take it because I think these out years, which are impossible to project, right? These out years of 24, 25, 26, I don't put a lot of stock in those. But I do see how AMD could get back to double-digit revenue growth. And if you do believe the out years when it comes to 2024, you could hit a significant EPS hurdle into 482. So AMD from a bottom fishing perspective, let's check this valuation tab. So this puts it up right against the rest of the industry, which you can see over here is semiconductors, okay? So if we get into non-GAAP in the semiconductor industry, we look ahead to forward, they are trending under the sector median. They report in non-GAAP earnings, so even though this GAAP earnings number is significantly higher than the median, this is what AMD reports in. That's what the street takes as the Bible. So we'll stick with, we're not going to try to change that, I guess you could say. And then if we go down to PEG ratio, minus 54% on PEG ratio. What about sales? Price to sales, just under 4. That's a little bit higher. Price to book, though, is lower, both this past 12 months and forward. And then price to cash flow, right in line with the industry if you look ahead to forward. So with AMD, I don't know if I would say rock bottom price, but considering where it has traded in the past, I'd feel pretty good about adding here. All right, back to the board. Let's keep looking at growth. We have Amazon, Amazon D- on valuation. And I'll show you with Amazon, who I think is a great long-term stock, but you're not going to see a lot of it from the next year or two forward projections. Okay, so this year, after a long run of EPS positive quarters, they're actually going to go negative for the fiscal year. Next year, they dig out of that hole. You got a forward PE of 50, which isn't, terrible, assuming that AWS keeps going strong. On the revenue side, though, you are barely hitting the double digits now, and this is where it gets harder with Amazon. and that 50 forward PE, some people will argue that that's just too high. I get where they're coming from. I guess I would just say with Amazon, as big as they are, to continue to grow at plus 10% on the revenue side, and then getting back into positives on the EPS side, it's a good thing. I'd put it in with the AMD in the situation that it could definitely go down again. And I'm not going to say that $90 is the bottom for Amazon the way things have been going. However, I do see some value into DCA into Amazon over the next year, right? So waiting for the most of this last bad news to pass, and then you got to cross your fingers that AWS keeps growing. I've got my Amazon within the QQQ. I'm very happy with owning a portion of it there. But here at today's price of 90, I think you need one more positive catalyst to come out in the headlines before you get too excited about buying. All right, back to the board looking at growth. We have Datadog, which is getting an F in the valuation. It is getting B plus on EPS revisions and A in growth. You know, F is not good valuation-wise. So let's just take a look at why we are getting an F. This fiscal period ending of December 2022, you got an EPS estimate just under $1. It's actually big time growth from the year before, but you are in a 77 for the forward PE. Now, again, in a couple months, you're going to be talking about 2023, and that would bring it down to a 61 if they did indeed grow by 26%. Let's take a look at these revenue numbers. And this is what I think it's intriguing, okay? This is where you start to see the big growers when you're talking about numbers like this. Let's throw away 2022 because it's almost over. If they hit 60-some%, that's fantastic, but it's probably already been in the news, right? It's already in the valuation. But if they get to plus 30% next year, that's pretty impressive, particularly when you start looking at some companies whose growth projections have come down substantially over the past year as the stock market has cratered. And here we still have projections for 34% against 28 analysts. I'm not going to say that the 10 on forward price to sales is cheap, but I think this warrants watching. At least learning more about it. I can't give you the 1, 2, 3 on Datadog as terms of what services they offer and what the growth prospects are. I'm just going strictly by analyst projections here. But I would say that given the upward trajectory, and let's see earnings revisions here. Yeah, so earnings revisions over the last 1 month, so that incorporates some of this bad time we've had in the market. Last 1 month, they're still getting positives, plus 16%, plus 10% for next year. And on the revenue side, a little bit of slipping here in year 2. But overall, keep your eye on Datadog. I think this one's worth a watch list at the bare minimum because it does seem like in a period where growth is being questioned, Datadog is offering top and bottom line growth. It's just that the multiples they're offering it at in today's current environment, it's tough to tell which way they'll go. All right, back to the board here. We were just on Datadog with an A for growth. Here we have Match Group, A minus for growth, B minus on EPS revisions. Let's take a look. This is a little bit more consumer services. Let's see what sector this is. Interactive, it's communication services, interactive media, and services. Let's get a feel for these earnings estimates for where we stand now. Okay, so you've got the forward PE for the end of the year is $18.34, assuming they do hit that $2.35 EPS, which is plus 50% for this year. Next year, almost 20% if they hit 275. That brings your forward PE down to 15. And then if we go to revenue, They're going to get to about just over 3 billion this year, which is plus 7%, and projections right now are plus 8% for 2023. They do have a strong out-year projection of plus 10% almost every year, depending on how much you can trust that. This is a tough one, though, for me because of the app game and how quickly apps come and go. It's really hard for me to feel good that another app couldn't come out tomorrow and potentially wreck their projections. So I'd certainly have to read more. Let's take a look. This is valuation versus the sector. Non-GAAP forward, they're at 18. The sector's at about 14. Gap forward, they're way above gap forward. PEG ratio, though, 0.5 versus over 1, that's good. What about sales? 3.7 versus 1.8. Okay, so cash flow, 12 versus 8. If you're going to buy this one, I'd have to say that you want to see something on the radar that's going to be a game changer for them since they are into basically dating apps, right? Like what changes in that particular consumer field that is going to help Match Group? Is it a new app that's gaining traction? Is it a new service that is, enticing more subscribers? I'm not sure, but I would need to have a bull case like that before I would jump in on this one. All right, let's try to pick off another one here on the growth tab. You have Cloudflare. Cloudflare is an interesting one, and I got to tell you, I'm actually watching this one myself. This is a stock that's down 81% over the past year. And they don't make a lot of earnings or, EPS. You can see this estimate here, 11 cents. That puts a forward PE in the hundreds, which is never good. And then even next year, a 34% growth on the bottom line still puts your forward PE at 273. Most people are not going to get too excited about that in this environment, but it's the revenue here that you're trying to get a piece of for the future. And for the future, I mean, this has to be a 5-year hold at these prices. There's no other way to hope to get your money back here. You look at the revenue, just shy of $1 billion this year, plus 48% growth. It's got your price to sales over double digits. Next year, they're way over $1 billion, plus 35%. And then these out years, I mean, unbelievable out years, depending on how much stock you put into those projections, but plus 30% for the, next 4 or 5 years. If it were to happen, your stock price is definitely going to go up. You're certainly going to catch up to the valuation. You have to ask yourself in this environment, how far in advance do you feel like you have to buy it? And that, to me, is the hard one. So with Cloudflare, I love the growth. I think it's worth watching, and I'm watching it myself. I wouldn't be surprised if we had some more dark days in the stock market that this one loses another 10-20%. It wouldn't shock me whatsoever. And I think if you buy it today, you're saying to yourself, 5 years. I'm not buying all in on one day. I'm going to go in. This is a 5-year hold, and hopefully their roadmap continues. It's a very impressive roadmap that I've studied before. I encourage you to look into it. But I wouldn't buy a Cloudflare today and call it bottom fishing in the sense that the stock can't go any lower. I would just say you're bottom fishing on a stock that's been annihilated, and 5 years from now could pay off handsomely. All right, heading back to the big board here, let's just sort by growth real quick and kind of cross-reference things that way. These are all A-plus growth companies. No surprise, they all have, arguably controversial valuations, if you will. Let's see if we can find any green whatsoever in the high growth. And I'm scrolling down. We talked about AMD. Charter Communications is in there if you want to take a look at that. And here, On Semiconductor. Let's take a look at On Semiconductor. I do think that there is some long-term value in semiconductors right now. I can't promise you they won't go down from here, though. That's the only problem. So earnings estimates for ON. This year, $5.27, forward PE of 12. And then, geez, see, look at this in year 2. At least right now, you know, you're losing 14% on that EPS line. It actually increases your forward PE. Now, what about the revenue? And that's where the problem is. You can see it stick out like a sore thumb. Next year's revenue is flat to down slightly. Okay, so right off the bat, from me and my money today, buying any stock going forward, I'm not going to buy anything that's projected, you know, revenue projected to be down. At the worst case scenario for me personally, I need to see an increase in revenue and then ideally hitting flat to at least plus a couple points on the EPS line. That's just me personally. There's hundreds and thousands of ways to value a stock. And most of the stocks in the QQQ that I pay attention to do not pay a dividend. And that, of course, is a whole nother calculation you can think about. All right, guys, so we went bottom fishing for tech stocks. There's some intriguing names in there, but I wouldn't say any of them were 100% close your eyes and buy everything right now. I think with each of those, you have to understand the unique story and where that growth rate's coming from. And in an environment like this, if you're putting everything down on one stock, you're probably making a mistake because it's just impossible to tell which way this economy and Fed tightening is going to go in the short term. That being said, there was a few names in there that are growing well, particularly on the top line. So maybe some DCAs in order if you understand their business offerings and how they're going to grow the company. All right, guys, let me know if there's any tech stocks you're following right now, or are you just hiding out in energy stocks like the rest of the world? And before you go, don't forget to check out that Seeking Alpha special offer in the description. My affiliate links down there get you $99 for their premium service for the entire year, 12 full months, not $99 a month. It's a heck of a deal. Use things like we use today, the stock screener. So definitely check that out. I hope everybody's doing well. We will see you on the next video.